Welcome. It's Mary Ellen McGonagle here with your MEM Edge show each and every Friday afternoon, where we bring you where the action is in the broader markets, as always with an eye toward helping prepare you for these market conditions, not just for next week, but beyond. So let's go ahead and get started. Take a look at what we are going to be doing and following this week. First up, we are going to take a look at the broader markets, see where did we close after this quite volatile period. We're also going to look at some of the more impactful news that drove price action this week. Volatility remains high. We can delve further into that and then look at specific areas that are being highly impacted. Also, earnings as a driver for price action. That actually does continue to be the case. We are still in the throes of earnings season Q1, and I will certainly dig into that today as well. And then building your watch list. There are those of you that might think it's a little too early, but it's never too early to know what to be on the lookout for as it relates to setting aside that list of stocks so that when the markets turn positive, you are prepared. So here we are with last week's headline news, and certainly the most impactful was Wednesday's announcement by the Federal Reserve that they raised the Fed funds rate by 0.5%, not entirely out of line. That was anticipated. They also will begin their bond buying program in June. Both items were as expected. The real news came in the fact that the Federal Reserve on Wednesday talked about a growing economy, and it was actually viewed as rather bright. The markets took that, slept on it, and the following day we did see a big drop on Thursday, of course, in the broader markets as those comments and actions were examined a bit more closely. We did see the interest rates rise as the Fed is in the throes of raising rates to combat inflation. The US dollar also on the climb higher. There were impacts there throughout the markets we'll get into. And then oil prices, they're now back up above $110 per barrel. Oil, big winner this week. And we did get news today on Friday that the unemployment rate did stay steady in April, but we did see wages increase. And this is all about inflation, wage pressures, and the markets responded negatively, selling off today. Next week, we are going to see some more impactful in the way of inflation-related news. The core CPI, Consumer Price Index, widely followed, also followed by the Federal Reserve. That will be released on Wednesday. And then on Thursday, we'll get the Producer Price Index, another inflation-related data point that the market certainly will be on the eye, have their eye on going into next week. So from here, let's go ahead, take a look at the S&P 500. We're looking at a daily price chart, a couple of key components and characteristics here as it relates to where we closed. The RSI, this is a relative strength momentum indicator. And during nice uptrending periods, such as this May into September period for the S&P 500, generally, despite some pullbacks here, you want that RSI to be above that 50 and trending higher. And unfortunately, since the beginning of last month, the RSI has maintained a presence below that 50 and then trending lower. Faster moving momentum indicator here, stochastics. This is another indicator that ideally you want it to be above 50 and trending higher. Stochastics down here, still languishing since, again, the beginning of last month, below that 50. So we are in a negative position. Let's take a look at where the S&P 500 ended, because it was flat for the week, but we can see really a lot in the way of volatility taking place. This February low of 4115 is near-term support for the S&P 500. We closed ever so closely to that 4123. So we are still holding above this area of support, but other key characteristics and components you want to keep an eye on is the volume as it relates to higher volume on down days, indicating distribution. So at the end of the day, we are not in good standing with the broader markets, S&P 500. So from here, let's go ahead and take this a bit further. We want to see what is taking place behind or underneath the broader markets. So we're looking here at a 2-month daily price chart of the underlying 11 sectors within the S&P 500. And I've gone ahead and added that RSI, relative strength indicator, and then up here on the upper left quartile will be your relatively stronger areas, certainly as relating to your weaker areas down in the lower right side. So let's take a look. Energy, the big winner this week, up 10%. We can take a look at this group chart, and it is not at an all-time high, but certainly at a near-term high. I need to pull up a monthly to give you a little more in the way of perspective, and actually we are. I do have charts that go back further, but certainly on this near-term view, we can see via the monthly chart how much of an uptrend energy has been in. Subscribers to my MEM Edge report will be all on top of this because we have been citing the group. We did add stocks certainly back here at the beginning of the year and more recently, and did advise this week the only area that you could be putting new money to work as the group continues to increase. A lot of dynamics taking place. It's not just the price of that oil, certainly other global geopolitical dynamics at play and earnings. This is a big play. A number of large energy stocks did report their earnings this week, and we'll get into a couple of those as we move forward. Some of these other areas relatively outperforming up here in the forefront: consumer staples and utilities, most certainly defensive. These are companies that do provide a nice higher yield. And then also, they are companies that have been able to raise their prices in the face of rising inflation, which in turn has helped them maintain their growth prospects. So, we're going to get into a couple of staples stocks that have reported of late and are on the move higher. From here, we can take a look at some of these areas that are down here in this lower quartile. Financials actually surprisingly outperformed the markets. They were up a little bit this week, but still very much in a confirmed downtrend. We'll get into what drove financials this week. And then also XLRE, and this is the real estate sector REIT. They do offer a high yield. They had been up there in the forefront as it relates to that relative outperformance, but really fell out of bed. This is something that I talked about in my last Sunday's report as it relates to why, and it is all about management coming out with their Q1 results. And many of the larger names were guiding lower into the remainder of the year. That is not what is working. And then we did get this break below key support. We did have two names on our suggested holdings list with my MEM Edge report, which we did remove last Sunday prior to this even further decline, but it really is swift. And this is indicative of what we are seeing in the market, unfortunately, where groups that are in favor, they don't slowly fall out of favor. It is a very sharp drop. So really staying on top of the market's industry group rotation is going to help set you apart, because actually it is occurring very, very swiftly, but that main primary draft backdrop continues to be not only corporate earnings, sales for REIT stocks, its funds from operations, but it is going to be management's outlook going forward. That's your big driver of these areas that are either getting hit or seeing strength. Not a whole lot of strength, but certainly it's out there. Beyond that, let's go ahead and take a look at some of the sub-industry groups that are beneath those sectors. And again, I've added that RSI for these ETFs that I track. I'll go ahead and jump through and take a look at some of these here. And again, descending order strength to weakness. So here up at the forefront is the yield on that 10-year, and you can see it continues to inch higher. Of course, the Fed is actively trying to raise interest rates. They did raise that Fed funds rate, but their bond selling program will continue to keep this rate or yield on the rise. And so this week we did tick up above 3%, one of those numbers that is very widely gauged as it relates to the yield on this 10-year. We now have that 3 handle, and that is significant as it relates to the impact on different areas. We can also see the US dollar continuing to tick higher. This is a lot to do with foreign uh, purchasers of US Treasuries with those nice high yields. It's pushing the dollar higher. Another area on the rise, I talked about Brent crude, now up back above that 110 level, generally trending higher. And again, a lot of dynamics taking place as it relates to Ukraine, Russia, and other areas, the Mideast as well, where conflict is uh, pushing prices higher in the face of lowered supply and increased demand. So here we are with volatility, and I mentioned this briefly, but we can see that the volatility index did get up as high as 35 and a little bit even beyond that. So what I'm on the lookout for with this volatility index, I have a 10-day simple moving average. That's this green line. We can go over to this left here, and it will tell you what that metric or what the data for that 10-day is, and it's 30.39. And the reason I'm pointing that out to you is that historically, if the volatility index gets 20% above that 10-day moving average, historically, you can see a reversal as it relates to the broader markets. As volatility climbs, that is not positive for the markets. This is also known as the fear index, and it's very much underscoring the uncertainty among investors. So we did get very close to that 20% above as we inched above 36, but we closed the day back down in that 30 range. So let's move on, take a look at some of these other areas because you want to make sure you're not involved. Certainly software, another tough week for this group, down 5%. Despite strong earnings from select companies, it is just really not the place to be, as it has not. We've been highlighting this as being in a downtrend for several months now. We can also see biotechs really selling off. They very closely came into a place where they were potentially reversing this downtrend, but not so. A lot of downside price action, continuation of this downtrend. And the reason I follow biotechs is because a move into biotechnology stocks indicates consumer confidence. I'm pulling, not consumer, I'm sorry, that would be confidence among investors. I'm pulling up a weekly chart here to highlight those periods when biotechs did fare well. They generally are companies that don't have a lot in the way of earnings. A lot of it is speculative, so investments in that area mean and indicate that consumers feel confident about, again, those broader markets, and we are not seeing that at this time. Another area that we did see up 2% this week, despite negative NASDAQ down 1.5, S&P flat, semiconductors. Now, we can see this big uptick that took place on Tuesday. Actually, that looks to be Wednesday with the broader markets. We did see a big spike on Wednesday in those growth stocks, but the semiconductor index, this is SOXX, remains in a downtrend. Each of your moving averages trending downward. We would not be a buyer, and we're going to need to see a lot more in the way of work before we turn constructive really in any area of technology at this point. I'm going to take a very brief break here. When we get back, lots more to cover. We'll be right back. Hi, this is Mary Ellen McGonagle, author of the MEM Edge Report. In my bi-weekly report, I highlight top growth stocks as they enter buy zones, and I educate subscribers on why that stock is attractive both technically and fundamentally. In addition, you'll be alerted to when it's time to exit that stock based on negative technical action. And this biweekly report gives you confidence by providing fundamental insights into why an area of the market is strong and which companies within that strong area have the best growth profiles that'll help propel that stock higher. Subscribers to the MEM Edge report are benefiting from my expertise in uncovering top performing growth stocks. Subscribe now to take advantage of my special trial offer. And we are back. I did mention to you how earnings behind the scenes, if you will, continues to be the driver of certainly individual stock price action. And I'm going to begin by sharing with you some of the more impactful earnings news related stocks, companies that came out with earnings, what occurred beyond that, and really what that meant for the broader market. So, first up, we are looking at Shopify. SHOP is the ticker symbol. This is an online software platform for retailers. So, what I did want to point out, certainly this group has been in a very sharp declining phase since peaking back here in November. Downside rally attempts met with upside resistance at their moving averages. So certainly wasn't anticipating, but a lot going into the release of their earnings this week. However, you did see bottom fishing here the end of last week into Wednesday, going into their report. And this is what seemingly is occurring periodically, where we have these really beaten down stocks, some of these software stocks down up to 80%. Buyers are coming in, and really you're not rewarded. For any of you that are potentially out there thinking that these stocks have gotten so inexpensive and their multiples are low, not that may be the case, but it is not in any way the time to be dipping your toe in. You will not be rewarded. You will have ample time once the markets turn positive and we start to see more constructive price action in the way of these stocks breaking back above their moving averages and trending higher. So let's get back to Shopify. SHOP. What I did want to point out to you is their report. They came out 90% below their last year earnings. So year over year decelerated growth of 90%. And the report, the earnings was 70% below estimates. So just a really sharp blow. And the stock, of course, deteriorated with that. So, in essence, sharing with you that concept that the growth prospects really are not there for a lot of these companies. I'm going to share with you a little bit later a uh, kind of a trick of the trade, if you will, as it relates to, I might as well jump right into that now, as it relates to keeping an eye on stocks that are and were big winners and gauging when they may potentially begin their descent. So this is Shopify on a weekly chart. And what happens, this is something that is historically precedented over many, many years. When a company enters into its growth phase and begins to move higher, let's take a look at another stock while I'm sharing this with you, because Shopify is a little bit unique. But here we are with the company Estee Lauder, just as a, for instance, very similar to a lot of these stocks that came out of this pandemic, individuals having to be on Zoom meetings. We did see a lot of the in the way of these cosmetic companies faring really quite well. But we can see Estee Lauder at the beginning of this year, similar to growth stocks, did begin to fall out of bed. But really, what is taking place is, historically speaking, you will find that these stocks that go on to great heights, it will take place over an 18-month period, generally speaking, because then what starts to occur from that sixth quarter on out, what's happening is the earnings reports that are being released now are being compared to a very healthy first quarter of last year. This is Estee Lauder. They came out with numbers, jumped higher. So at this juncture, they are competing against a very, again, high uh, growth period. So in essence, inevitably, they will have weaker earnings relative to historical precedents. So I did want to point that out. I'm going to share with you while we're here a couple of other stocks that are exhibiting very similar characteristics. And this is true. This is Ford Motor F. And we can see that we are just beyond that 18-month period, and the stock falls out of bed because their growth, they are seeing lower growth relative to a year ago. Most of these automobile related stocks are seeing very similar deterioration where they have super high growth periods from a year ago that are making their year over year comparative growth quite weak. So from here, let's go ahead and take a look. I want to circle back to this concept as it relates to what is taking place during this current earnings season. So here is a company, Insulet, PODD. I'm going to pull up a more orderly looking daily price chart, not the prettiest chart, but it certainly is indicative of what we are seeing. Take a look at this sharp drop here. The company actually reported earnings this week that were above estimate. The management also guided higher going into the remainder of this year. This sharp drop is due to the fact that their CEO is stepping aside due to family reasons, but it is creating that uncertainty, and hence we get a sharp deterioration. I'm pointing that out because during healthier periods of the market, when we are in a growth phase, there's not a lot in the way of uncertainty. That CEO stepping down type of news would not push a stock down double digits. It's just that fear factor, that uncertainty. Let's take a look at some other companies that did report earnings. I have a lot that I can share with you here, but this is McKesson, MCK. They are a healthcare company. I will go ahead and pull up a daily chart here so you can get a better view. It's up 6% on an otherwise down day today. So what I did want to point out to you is that MCK reported their numbers. They were not above estimates. However, management guided growth higher for the remainder of this year, and that's all investors needed to hear. We can see the stock has broken back above its 10 and 21-day moving average, broken out of a base. You really wouldn't know what was going on elsewhere in the market, but again, that guiding higher is the differentiator as it relates to corporate management seeing growth despite high inflation and high interest rates. Here's another company that just reported. This is Kellogg. Ticker symbol is K. And you can see this big spike up, also up another 4%. Again, all about earnings. This company has been able to raise their prices in the face of high inflation, keeping that growth intact. The other thing here is at this time, relative to growth stocks that some of them still do have high multiples, Kellogg is trading at 17 times trailing four quarter. So a nice low multiple, also provides a 3.2% yield. We did see a move into yield providing ETFs this week. So giving a sign of what investors are on the lookout for. I'm going to share a couple of other stocks here that did falter despite showing growth. And this has everything to do with the industry group that they're a part of. So up here is HubSpot, HUBS. It was a big winner, but we can see that the stock has dropped. They had 74% in the way of year-over-year growth, 15% above estimates, but the stock did sell off despite that. And another software company that reported, FICO, 53% year-over-year growth, 25% above estimates, and the stock is trading lower. Just heavy group pressure is continuing. This is software. I mentioned to you that software sub-industry grouping, still very much in a downtrend. Let's take a look. I think we have, yes, we do, plenty of time. I'm going to share with you some stocks that had positive results and positive response. So this is Waters, WAT, and really more for an educational. This is not a stock that would be attractive to me at this point in time. But when you are looking at potential downtrend reversals, we're seeing nice high volume characteristics, the stock up multiple days in a row. We have positive RSI and MACD, signals, but we do still have this 200-day simple moving average, potential upside resistance. Even more importantly is the backdrop of the broader markets that's not in your favor. But again, we're really just more telling you what to be on the lookout for with these potential downtrend reversals. So here we are with Illinois Toy Works. I'm sorry, Tool Works, ITW. Company did come out with earnings above estimates this week. So again, that potential downtrend reversal. So what we can do is go back to this September into October period. And this is what I would need to see, certainly with a positive market backdrop as well. But the price breaking back above each of these moving averages, your outside momentum indicators trending positive simultaneously. So we're not quite there yet. From here, I did want to share with you a couple of other companies and areas that are potentially really holding in well. This is all about that watch list concept. You want to have that list so that in the event when the markets do turn positive, you are on it. So this is IBM. Some of you may have seen me or heard me speak about this company in the past. Let's take a look. They had a big, nice gap up, super strong earnings. The company guided higher estimates going forward, pulled back. Now, they did on Wednesday rally with that move into growth stocks, but they held, retained, and added to Wednesday, unlike many other growth stocks. So I'm going to share with you some of the components or some of the underlying factors that would keep this particular stock buoyed in light of other areas that are succumbing to market pressures. First up, we can see the yield. IBM is one of the highest yielding dividend aristocrat stocks. It's 4.7% yield, and we talked about that being desirable in the current market environment. And then the multiple, it's trading at 22 times trailing 4-quarter, which is quite attractive. We can see the outside momentum indicators appear in positive territory. So certainly a good pick for your watch list. Let's take a look at a couple of other companies that have reported here. This is Cigna, CI, up almost 6% today. They did announce results and guided higher. They've seen a big uptick in subscribership in membership. So we can see this nice move up. RSI trending upward. MACD remained in positive territory and then poised to have that positive crossover. So these are the characteristics that I'm on the lookout for. Strong earnings growth, remaining above key moving averages, and constructive RSI and MACD characteristics. I'm going to leave it at that. If you have not already, go ahead and trial my MEM Edge report. It's a twice weekly report, keeps you very on top of the markets, sector rotation, whether it's safe to be wading into those waters, and you can experience a 4-week trial at a very nominal fee. Have a great weekend, everyone. I'll see you here again next Friday.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.